Scott Bauer, he's the CEO of Prosper Trading Academy, is joining us here to talk the jobs number and market reaction to. Scott, welcome to the broadcast. Thanks for joining us here this morning. I noticed that the unemployment rate inched down a little bit, but it did look like the non-farm payrolls came in a little bit below expected. It does look like the market's getting a little bit of a lift from it here this morning. What are you seeing?
Yeah, first look at it is a real mixed bag, Ben. Yeah. Like you said, unemployment rate down to 3.5% from 3.8. Non-farm payrolls come in a little light, not horrendous, but a little light. But on the flip side of that, August payrolls were actually revised up. So, you have this mixed bag. I'm still concerned, though, because given the ISM numbers we got earlier in the week, given some of the headwinds that we're now facing on the economy, these numbers aren't so great here. And unfortunately, I feel like you have to fade this rally that we've seen over the last 2-3 minutes since the number came out.
Scott, I don't think you're alone in terms of some of your concerns. I mean, ultimately, we talk about how jobs a lagging indicator. The ISM may be a little bit more closely tied to some of the most immediate activity that's been playing out in the manufacturing sector. I mean, the jobs component associated with some of these manufacturing numbers we received this week was a bit of a disappointment. Do you think it could be kind of a situation where we could see those numbers start to play out over the next couple months, not necessarily yet this month? I mean, we've also been hearing, keep in mind, about some of the layoffs that have been playing out here as well. I noticed this morning HP, something like 16% cut, and we heard about, the situation that's been playing out here with GM.
So here's my big concern is, when we isolate one number, so last month's number, the number was 140 or whatever it was, a light number, people looked at it and said, yeah, not good, but it's a one-off. Well, this is another one of those one-offs. So the more that these, weaker numbers start to build up here, and like you said, these are lagging indicators, right? They're not leading indicators. The jobs number is a lagging indicator, meaning, okay, if these numbers are weak, that means the process has already been rolling for a slowing economy here. And like you said, we've got lots of layoffs in the headlines here. I'm really concerned going into the holiday season here. Obviously, we're going to see some seasonal hiring coming up here, but that's what that is. That's seasonal hiring. Even though the unemployment rate is lower here, this is very, very concerning to me, Ben.
All right, in addition to some of the concerns associated with the unemployment rate, as you mentioned here, Scott, let's talk a little bit about, there's got to be some concern here associated with the average hourly earnings, which came in at 0.0%. They were looking for 0.3%. That's on a month-to-month basis. If you take a look at the year-over-year, you're going to notice here that it came in 2.9%. That was also a bit of a drop, Scott. 3.2% is what they were looking for. That was the prior number as well. I mean, Scott, when we're talking jobs, really we tie it back to this wages component because ultimately that ties back to the inflation component that the Fed's looking at. And I guess I'm wondering your thoughts on this one because it doesn't seem like, at this point at least, we've seen any shift as far as a tight labor market, but yet very soft wages here in terms of increases.
Yeah, and that probably concerns me the most out of everything that was reported because, that leads into inflation numbers. Ultimately, that leads into the consumer. And the consumer has been the rock of this economy, has been the rock of this market over the last, umpteen months. If we start to see cracks in the consumer, that's where we really have issues. Now, I'm looking up at the market here, and yeah, like you said, pretty muted response. The market was actually anticipating a major response one way or the other. In fact, at the close of the market yesterday, the E-minis were pricing in a 26 handle move just for today. Most of that, tied right to this number this morning. I expect, a bigger move coming out through the trading day here, and I would think it's going to be to the downside from here.
Scott, I'm going to just kind of cycle through the indices here so our viewers can see. We have the ES, which actually just posted a new high up to 2920. And if we could take a look here at this chart on the 5-minute time frame, new highs in the ES, Scott. We've got a new high just posted in the Dow up to 26,268. You got the NASDAQ up to 76,95.75. Looks like across the board, for the most part, the indices are up around 0.25%, 0.1% or greater. Scott, we're talking about the Fed and potential for them to have to cut. I start to wonder sometimes at the impact that another cut could have. I mean, or even if we were at the point, basically, at what point does the impact from monetary policy and cuts kind of lose some of its bang for the buck? I mean, we've noticed here negative rates in the EU certainly isn't helping things in terms of their growth potential or inflation numbers. I mean, again, is it monetary policy alone that's going to resolve the situation that we're dealing with if it's a slowdown, an economic slowdown or end of cycle type activity that we're faced with?
And that's the catch-22, and that's why we saw the market rally yesterday, because even though we got more negative news yesterday, the positive out of that was that, okay, people thought, all right, not so good. Fed's going to cut. They're forced to cut. In fact, yesterday, the CME FedWatch tool went all the way up to almost 90% of an October cut. Well, you look at this number today, and to me, that's why the market is rallying right now, is because even though this is a soft number, even though this is showing that, yes, there are some cracks in the economy, well, that's leading probably to a 100% possibility that the Fed is going to cut. But to your point, Ben, how much of a cut, whether it's 25 basis points, 50 basis points over the next few months, how much is that actually going to help? And, I just think that we're starting to really see the cracks of the global slowdown here. And it really really concerns me. And unfortunately, in my opinion, and I'm always an uber bull, Ben. I am an uber bull. That 2830 area that we almost tested the other day, which is the 200-day moving average in the S&Ps, I think that's not far away.
Yeah. All right, something to watch. I've been pointing out that 200-day moving average. Scott, I'm glad you brought it to our attention. Scott, I've got one more question for you. Everyone's looking for signs of a late cycle in terms of labor market, in terms of some of the manufacturing data. I'm wondering, did this give us any indication that we're headed into late cycle conditions here? I mean, wage growth is basically flat at this point. We notice unemployment inched down a bit. Basically, any sign that we're near the end of the cycle here in reaction to today's jobs numbers?
I mean, you have to think we're in the ninth inning, or at least the bottom of the eighth inning. All the numbers are pointing to that. And again, go back to how we started this conversation. This jobs number is a lagging indicator. It's not a leading indicator. So the fact that we've now had 2 months in a row of weakness here shows that this has been in the works for some time now. And that's really what concerns me.
All right, a lot going on here, Scott. I appreciate you taking part of your day out, or taking time out of your day to be part of our broadcast here on the Futures Show. Traders, again, this is Scott Bauer. He's joining us to take a look at the market's number, and he's joining us from Path Trading Partners.